While markets obsessed over modest index declines this week, the real story unfolded beneath the surface where 300 S&P companies rose even as headlines showed red. This is exactly the kind of misdirection that creates exploitable opportunities for those who understand what actually drives price movement. Most traders fixated on the SP's modest decline or the Nasdaq's weakness, missing the profound internal redistribution happening across sectors and market caps. The Russell 2000 just completed its 9th consecutive day of outperformance against large caps, the longest streak since 1990. Meanwhile, energy stocks hit new highs, financials rallied on earnings beats, and semiconductors split between infrastructure plays and end-market exposure. This isn't random noise, this is systematic capital reallocation. Here's what's actually happening. After 3 years of concentrated tech dominance, human psychology is demanding diversification. Loss aversion kicked in hard when JP Morgan beat earnings but still dropped 4% because investment banking disappointed. Yet Goldman and Morgan Stanley rallied on their results, not because they were exceptional, but because they cleared the lowered bar JP Morgan set. The market is trading relative performance, not absolute value. Taiwan Semiconductor's blowout quarter and $54 billion capex guidance for next year triggered confirmation bias among AI believers. While Nvidia faced China export restrictions, TSMC's infrastructure commitment validated the build-out thesis. This created permission for chip stocks to rally despite broader tech weakness, a perfect example of how singular data points override sector sentiment when they align with existing beliefs. The inflation data revealed another psychological trap. Core CPI came in at expectations, yet traders anchored on the 2.6% print as dovish Fed confirmation while ignoring services inflation stickiness. Meanwhile, oil rallied 7% in 5 days on geopolitical supply concerns, creating input cost pressures that contradict the disinflation narrative everyone wants to believe. This behavioral pattern creates systematic opportunities. The market architecture itself amplifies these moves. The Dow's price-weighted structure and financial sector allocation insulated it from tech rotation, while the Nasdaq's cap weighting magnified Magnificent Seven declines. When you understand how index mechanics interact with human psychology, these divergences become predictable. The bond market is sending clear signals that consensus is missing. 10-year yields holding above 4% despite benign CPI data means institutions are pricing structural inflation persistence, not cyclical cooling. The steep yield curve supports financials and cyclicals while pressuring duration-sensitive growth stocks, exactly the sector rotation we're witnessing. Commodity markets are screaming warnings about the soft landing narrative. Gold hit new highs above 4,600, silver reached all-time peaks, and oil's geopolitical rally suggests supply constraints that inflation models aren't capturing. These moves reflect institutional positioning for stagflationary outcomes despite consensus expectations. The Stoic approach recognizes this rotation as natural order reasserting itself. Markets abhor extremes and seek equilibrium through cyclical rebalancing. The concentration in tech created the illusion of permanence, yet this week demonstrated that all regimes eventually yield to their opposites. This isn't disruption, it's reversion. What matters is distinguishing signal from noise. TSMC's massive capex commitment represents revealed preference. Capital allocation speaks louder than sentiment surveys. Corporate spending decisions are among the most reliable indicators of genuine conviction, validating infrastructure themes while remaining agnostic about timing and valuation. The breadth expansion signals opportunity dispersing from concentrated positions into the broader market. This is the natural life cycle of bull markets: concentration during acceleration, dispersion during maturation. The disciplined observer reduces concentration risk while maintaining equity exposure through broader participation. Volatility compression to VIX 15, despite geopolitical headlines, reveals either complacency or sophisticated hedging, dampening volatility transmission. The market's muted response to the DOJ Powell investigation and Greenland tensions shows participants distinguishing between theater and genuine threats to the monetary framework. The system rewards those who adapt to what is, not those who cling to what was. This week delivered modest headline declines, yet significant internal redistribution. The disciplined approach extracts information from price action and adjusts positioning accordingly, recognizing that the most important market movements often occur beneath the surface. Process trumps outcome. The market's natural mechanism for correcting imbalances creates opportunity for those who understand that concentration eventually yields to dispersion, growth rotates to value. and large caps give way to small caps, not through prediction, but through preparation. Subscribe if you value systematic thinking over emotional reactions to headlines. Download the complete framework in the description to understand how human psychology creates exploitable market patterns.